What a difference a month makes. It seems like just last month we were talking about signs of change and a cooling in the real estate market. And here we are a month later, and there's definitely a change going on, which many of you have probably noticed. And the three biggest storylines over the past month have had to do with mortgage rates, increasing talk of are we heading for a correction, and what the impact of a recession is likely to be on our real estate market. So, those are the three topics I'm going to cover in this month's real estate market update. Hi, this is Andrew with the S2 Real Estate team of eXp Realty, coming to you as always from Frisco, Texas. And man, the real estate market's definitely showing some signs of change without a doubt. It's still important. I'm going to preface to point out that the market over the past few years has been white hot, it just flying like crazy. And although it's cooling, it's still a hot market. But is it going to stay that way? That's what we're going to dig into a little bit today. And one of the key areas for that has been mortgage rates. Now, mortgage rates have undoubtedly had a huge impact in the market. They jumped substantially from the beginning of the year through the beginning of April. And that, in effect, took some of the buyer demand away. Buyers took a step back as those mortgage rates rose, especially in the face of inflation and the price of everything being so much higher, and just kind of paused. Completely understandable. But what we saw mortgage rates start to flatten out. I'm going to share my screen with you here and kind of show you what we're talking about. So here is how mortgage rates have tracked for this year. So as you can see, back at the beginning of the year, right around 3.11%, and then we jumped a full 2% by the third week of April. And from that point in time, rates basically flatlined. And the reason for that is that most of the economists out there and most of the mortgage companies, what was expected to happen in the economy had already been factored into rates. Now, with that in mind, the Federal Reserve said to combat inflation, they're going to do a series of rate increases this year, the federal funds rate, and they'd expected those increases to be between 1/4 and 0.5%. And the first rate increase was 0.5%, or I should say the most recent increase was 0.5%. But since this chart came out just last week, the inflation numbers were considerably worse than expected. After turning slightly lower, they actually jumped back up again, which took everyone by a little bit of surprise. As a result, yesterday, the Federal Reserve announced that at their next meeting, they may in fact raise interest rates 0.75% in order to try and get inflation more under control. Well, the mortgage markets didn't take kindly to that news, as they had not factored in a 0.75% increase in that federal funds rate, and it caused mortgage rates to jump. Yesterday, as a matter of fact, they jumped to over 6%. They have eased back down some this morning, but there's a lot of uncertainty out there. And as a result, you're going to find that there is volatility in the mortgage market. Now, again, as I've spoken about in the past, the 30-year fixed rate mortgage is not directly tied to the federal funds rate when the Fed changes their interest rate. That affects car loans, savings accounts, consumer loans, personal loans, credit cards, all those type of things. But it does impact the overall economy, which therefore impacts the bond prices. And the 10-year Treasury bond is what's usually more closely associated with 30-year mortgage rates. In fact, historically, the spread between the 10-year Treasury bond and the 30-year mortgage rate has been about 1.7%. Right now, it's actually trending at 2.2%, so it's a little bit higher, but that 1.7% number is one to watch. Now, as a result, does that mean home buying is going to stop completely? No. I mean, it never has. Homes sold when rates were 9, 10, 11, 12, 13, 14%. But it's definitely giving people pause. And what we are starting to see is more adjustable rate mortgages come back into the market. Now, before you panic and say that's what caused the problem last time, that's not entirely true. It was predatory lending practices, no income, no asset, no verification, credit scores only, stated income, basically liar loans. None of those exist. Those flat out don't exist. Adjustable rate mortgages that are coming out now, you still have to qualify for, but they could be an option for certain borrowers. So for instance, as of that rate went up yesterday, but as of just a couple of days ago, a 5-1 ARM was coming in at just over 4%. That means you can lock your interest rate in at just over 4% for the next 5 years. Works out great for people possibly buying their first home. They can move into that home. They may live in that home 5 or 6 years. They get the advantage of a lower interest rate to begin with, and then they'll end up selling that home and move on. But are they going to be in a position to move on if the housing market goes into a correction? So that's the other area that I want to touch on today. Are we, in fact, in a housing market correction? There's been all kinds of talk about that recently. There's all kinds of news reports out there speaking about it. But most of the experts are saying, no, they do not forecast a full-blown correction. There's going to be a lot of different opinions, and you are completely entitled to take the information that I provide and whoever else you listen to provides and make the best decision for you. But without getting into semantics here, the technical definition of a correction is a decline of 10% or greater in the price of a security asset or the financial market. And the little graph here shows that the average home price forecast appreciation for 2022 is still 8.9%. So all of the experts are still forecasting that home prices are going to increase for the remainder of 2022. I can tell you here in Frisco, Texas, I just received yesterday the latest forecast of prices from Zillow Group. And for this particular area, Zillow are still forecasting price appreciation in the next 12 months of about 13%. So again, you can say, well, how is this possible? Well, it still comes back to supply and demand. All of this and what we're dealing with in prices comes back to supply and demand. And we've been talking about this for quite a while. The last couple of years, you had extremely high demand, partially fueled by ultra low mortgage rates, coupled with record low supply. What we've seen over the past few months is the interest rate has gone up, the mortgage rate has gone up, buyer demand has started to pull back. We've also seen that new supply is coming onto the market. As a matter of fact, as of yesterday, there were just under 400,000 homes for sale across the country. That's a 13% increase over what we saw last year. But again, some perspective here is needed. If you go back to just 2019, at this time of the year, there was about 950,000 homes for sale. So we're still way below historical norms, but it is starting to create a little bit of balance and bringing a little bit of balance back, which is exactly what's needed. I can tell you that over the past couple of weeks, the number of emails I've been getting from local home builders starting to offer interest rate buydowns, price cuts on certain models is increasing. We are seeing that because they're not seeing quite the demand that they were. Most of their wait lists have been clear. As a matter of fact, just this weekend, I was in a new construction development. There was a house going up for sale, or it was open for offers, and they had 6 offers in with the offer period closing 12 hours from when I was there. Now, still 6 offers. A month ago, that would have been 30 offers. Even the sales manager said, yeah, he goes, we're still getting multiple offers and some bidding wars, but not on every single property and not to the extent that we were just a couple of months ago. But we have to keep some perspective here and understand that what we're experiencing here in North Texas is not going to be the same as what's experienced in California or Arizona or Idaho or Florida. It's going to vary depending upon where in the country you are. As a matter of fact, Mark Zandi, who's the chief economist at Moody's, he was recently asked about this. And Moody's are generally very, very conservative when they put out their information on what they think is going to happen. And, he openly said the boom is over. But he also said he doesn't expect rapid price depreciation. He expects home prices in the majority of the country and on average to flatline, possibly go to zero, except for a few of the most overvalued markets. He said they could see price declines of 5%, maybe 10% in some of those markets. Not all of them, and it will be isolated cases. Overall, though, they're not expecting anything like what we saw back in 2008. So with that in mind, I think Danielle Hale, the chief economist at Realtor.com, said it best. Rather than a full-blown correction, the housing market's at a turning point. The frenzy that we have seen for the last couple of years is over. We're starting to see signs of a new direction, but the ball is still in the seller's courts in most housing markets. And I think that's the most accurate assessment that I've seen. And again, it's going to be different in different areas of the country. But here in North Texas, this is exactly it. So what does that mean for buyers and sellers? Well, from a buyer's perspective, it's going to mean that there's less competition. You're going to face fewer multiple offers and fewer bidding wars. We're still seeing bidding wars on homes here priced anywhere around the 400,000 mark. You start getting into more expensive homes, they're not seen as many. Although $1 million property we looked at last week did get multiple offers as well. So it's going to vary from house to house, but it's definitely a cooling from what we've seen. So again, perspective is very important, right? So with regards to perspective, let's take a look at the showing index. So this only runs through April, right? So this is kind of an idea of demand. How many people are out there looking at homes? And this here is from Showing Time. They track the number of showing appointments that are made on properties listed for sale across the country. The important thing is here is if you go back, this is April 2020. Right after the lockdowns hit for the pandemic, you can see showing activity plummeted. But this was the level of activity we were seeing on listings going into the pandemic, going back to June of 2019. This is what happened post-pandemic. And here's the 251 is the reading that we saw just in April. Yes, that has come down from where we were in April. But again, it's still important to remember that we're still ahead of what we saw pre-pandemic in what everyone considered very strong, healthy real estate market. So the fundamentals were still there. Now, I'm not trying to paint an overly rosy picture. I'm just trying to present the information so that you're getting it based on fact and not just a headline out there that's intended to scare and worry everyone. If the bottom's going to fall out of the market, I'll tell you. If I see any signs that the market is about to crash or correct, I will tell you. But right now, we're not seeing it. None of the major economists out there, real estate industry experts, are forecasting it. As I mentioned, Moody's aren't forecasting it. Mortgage Bankers Association, Fannie, Freddie, go down the list. None of them are. But saying that, there has been increasing talk of a recession. And you're starting to see many of the CEOs of the Fortune 500 companies are saying it. Chase CEO has said it, that we're looking for a recession. Elon Musk has recently said we're looking at a recession coming up. So what does that mean for housing? And does that mean that the crash or the correction that many have been saying is going to happen is right around the corner? The honest answer is I don't know, because what happened this past week with inflation jumping higher was unexpected. So the result of that has been the spike in mortgage rates, which will further curtail demand as supply goes up and starting to bring some balance back in. What I can tell you, though, is that a recession does not necessarily mean housing prices. It hasn't, right? So as we take a look at this is the last slide I'll share with you today. Here's what's happened during the past 6 recessions in the housing market. As you can see, 1980 and 81, home prices still increased. 1991, they decreased slightly. That goes back to what Mark Zandi from Moody's was saying. He sees prices flatlining. That's relatively flat overall at down 1.9%. In the 2001 recession, home prices went up. In 2008, that was the great crash. That was the worst it had been since the Great Depression. It's being shown as a once in a lifetime event. They're not forecasting anything remotely close to that. And then in the recession as a result of the pandemic in 2020, home prices still went up 6%. So again, when you look at all of this, a recession doesn't necessarily mean bad news for the housing market. But again, things are changing rapidly. And so, if you don't subscribe to this channel, please do so. Hit the notification icon, and or the bell, and whenever I put a new video out, you'll be notified. What I want to do here is provide you the information that is factual, based upon the latest numbers and the forecast that the experts are putting out, so that you can make the best decision for you and your family, as that what matters most. So again, we are seeing slowing, but that is honestly a good thing. We needed it. The craziness that we've been in hasn't been good for anybody. So as I mentioned before, for buyers, if you've been looking and you can still afford it, there's a great opportunity to get into places without the crazy bidding wars. And for sellers, don't expect your home to sell in the first weekend. The average days on market nationwide is now 17, which is still ridiculously low historically, but isn't the multiple offers in the first weekend that we have all kind of gotten accustomed to. So hopefully this helps. And if you have any additional questions, please don't hesitate to reach out. You can reach us at 469-296-2530, or give us a email, or send us an email at contact@s2realestateteam.com. Otherwise, I will look forward to catching up with you in next month's market update.